Hello, everyone. Thanks for joining us today. This is the 2019 Bull, Bear, and Base Case Outlook by Point View Wealth Management. My name is John Petrides. I'm a Managing Director and Portfolio Manager with Point View, and joining me today is David Dietz, the President, Founder, and Chief Investment Strategist of Point View. Thank you so much for joining us today. We're going to give some attendees a little bit of time to register. I see people coming in now. And then we have a slide deck that obviously this topic could really go on for hours. There's so many issues to discuss, particularly after 2018. There's so many issues, so many topics to go over. But we're going to do the best that we can to consolidate this to a 20, 25-minute type of webinar, Q&A to follow, and then obviously any questions or thoughts that you have, send them our way. Before we begin, a couple of housekeeping issues. You can see on the side there's a poll there, and the question today is, do you think the U.S. political situation will send the U.S. economy into recession? Some of you have voted already, which we appreciate, so keep up with that. And obviously there's a chat room. All the questions are private, so no one else on the webinar outside of David and myself can see them. So please feel free to ask questions. We'll get all the Q&A at the end of the presentation. So if there's a topic of mind, that a question that comes up during the call, feel free to type it in. So what we're going to do now is I'm going to turn the mic over to David here to begin the presentation. David?
Yes. Thank you so much, John, and welcome everyone. We're very proud to present this webinar. Big shout out, of course, to John Petrides and our assistant Marcela Garcia for putting this whole format together and being able to do these monthly series. I think it makes a huge amount of difference. Before we get into the nuts and bolts of our topic today, we just want to talk a little bit about who we are and how we try and help our clients. First of all, of course, we are based in Summit, New Jersey. Most of us actually live in Summit, but of course our clients are not just in the greater New York area, but really throughout the United States and indeed some that are overseas. We're most proud of the fact that we are independent. We're not controlled by any kind of mega bank. We don't have our own products to sell. We don't have any hidden agenda, but we are of course fully and highly regulated by the SEC. We are registered investment advisors. I think the important thing about that is that therefore by law, we have to adhere to the highest standards of fiduciary duty, not some sort of watered suitability standard that many of the brokers adhere to, but always putting the client first. So what exactly do we do? There's really two things. One is we manage our clients' accounts. We do investment management. But on top of that, we try and act like the CFO for our families. We want to, if it's a financial question or issue, we want to be involved. We want to provide answers. We want to provide options. So we have holistic financial planning. And who do we do this for? Primarily private people, individuals and families, although we are also very lucky to have some small institutions, nonprofits, and endowments that we're also able to advise on. Managing money for private families is much more difficult than for endowments in a sense, because it's not what you make, but it's what you make after paying taxes, which is why one key reason we part company from the competition is we don't simply take our clients' money and throw them into funds. No, we buy what the funds would buy, which is individual stocks and bonds. So we're in control. Why would we do that? A lot of reasons, but one is it allows us to customize the portfolio. It allows us to do an end run around a whole another set of fees. It allows us to carefully calculate and control the tax outcome by controlling turnover of the various positions, and it avoids duplication and enhances transparency. Unfortunately, for that kind of very curated attention, we need to have a minimum relationship size that is $500,000. The cost for this is very transparent. It's a flat 1%, which includes not just the investment management, but the holistic financial planning. Of course, that financial planning is headed up under the offices of Claire Toth, who's a tax attorney with over 30 years experience. So the value proposition here is that you get the financial planning in addition to investment management, and you do the end run around a whole other set of third-party fund fees from third-party funds and ETFs that are often used by other advisors. We also have a program where for a flat fee, you can hire us just to do a complete soup to nuts review of everything you're doing financially, chapter line versus to how we would invest the assets and what we'd be doing from a financial planning perspective. Then if you choose to take the next step, dollar for dollar, everything you paid for that analysis would be credited against ongoing investment management fees. And finally, but not least important, is where is the money held? It's not held by Point of View, it's held by Fidelity Investments, one of the top custodians in the world. Security and safety of your money is always job one. Next slide. We've been doing this for 26 years. Along the way, we've received some national recognition. We don't like to toot our own horn, but fortunately, some others have done that for us. CNBC, not too long ago, ranked us number 5 in the nation of independent investment managers. And just this year, the Financial Advisor magazine recognized us as one of the top registered investment advisors in the United States. John and I couldn't do this if we weren't supported by a first-class team. That includes members of our financial planning team, our other portfolio managers, including Donna St. Amant and Elaine Phipps, and of course, then service representatives, which basically handle all the other questions of money movement and account statements and all the nuts and bolts of making sure that people have the very best experience possible. And here's the group there shown in front of you. Next. So let me give you an overview of some of the issues confronting investors this year, and then I'm going to invite John Petrie to do the deep dive into each one of them. Always the number one issue for investors is the health of the economy. When you look at the health of the economy domestically, things look pretty good. Everyone who wants a job basically has a job. Wage growth is expanding. GDP is at what last year at certain points was over 3%. We feel it's going to be positive this year. There's a few soft spots in terms of the real estate and autos, but basically it's a strong economy. But of course, our job has to look beyond the domestic economy and look at the global economy. And they're not as fortunate as the United States is. And because up to half of the revenues of the S&P 500 are coming in from overseas, we need to pay attention to that. Another key issue, of course, is the Federal Reserve and their interest rate policy. Last year, everyone was on tenterhooks of interest rates. This year, things look like they're going to be more quiescent and quieter, and John's going to explore that a little bit. Finally, of course, in the news is trade policy. And right now, of course, we have imposed 10% tariffs on much of what we import from China. Absent further negotiations and resolution, that's scheduled to go up to 25% in March 1. Trade is the linchpin for economies. The more you tax anything, the less you have of it. So it's critical for us to keep analyzing what the outlook is for that and how that's impacting financial markets and the economy generally. Of course, when you're talking stocks, the only reason to buy a stock is what that company is going to earn. So we are constantly looking at the projection for revenues, for profits, cash flow, and looking at the debt levels that are associated with generating those types of earnings. Here, the news is good. On balance, we're looking for stronger earnings in 2019 than we saw last year. That's a big positive. And finally, of course, we're in the longest government shutdown, partial shutdown, albeit, that we have seen. Historically, shutdowns have not had a major impact on the economy. A little bit like a hurricane or a strike by one of the automakers, local impact, but over time, it's not really noticed. But on the other hand, this one's gone longer than any other shutdown. Today, I believe, is the second paycheck that many up to 800,000 government workers are missing. And so it's part of our job to figure out where is all this going and how does that impact our clients' portfolios. So now I'm going to invite John to do the deeper dive on some of these issues.
Thanks, David. As you mentioned earlier, and David went through all of these issues, we could do a webinar topic on all 5 of these. So what we're going to do is, because there are so many cross currents, we're going to go through the details of each of these issues and then provide our guess or our analysis on the bull, base, and bear case for each one of these. We're in an environment now where there's a lot of cross currents. We just came off the largest bull market in history. It's not, there's no pounding, table pounding investment idea today. There's a lot of issues out there, although we do think stocks are more attractive than bonds and cash, but we'll get to all that. So it all starts, of course, with the health of the economy. And in the third quarter, this time last year, we were talking about a global synchronized growth where the entire world was moving in the right direction, up and to the right. And the U.S. was just coming off of tax reform, and it looked like blue skies ahead, particularly after 2017, where every index finished positive. So now, a year later, we're questioning, well, what's the health of the global economy? What's the health of the U.S. economy? And that really came to a head in the fourth quarter of 2018, particularly in December, where the market had the worst December in almost 100 years. But by and large, and we're seeing the data come through, yes, the economy is slowing, but it's still doing okay. Wage growth is pretty strong. Now we've had a couple months now of consecutively above 3%. Unemployment is still below 4%. Housing starts have slowed, obviously with rising interest rates, but we're still above 1 million on an annualized rate. Just to put that in context, since around 1950, the average annual housing starts has been about 1.2, 1.3 million. So we're still just right around the average level there. Car sales are okay. Again, higher interest rates deter the marginal buyer of a car, but because it's more expensive to lend, but you're still doing around 16.5 million car sales. And the banks who just reported last week are coming in with really strong earnings. Their balance sheets are stuffed with capital, and their loan books are moving along, still showing growth. So by and large, the U.S. economy is doing okay. So what we did was, what does the future hold? And we try to wrap some probabilities or some estimates around that. The bull case is that the U.S. economy is going to grow above 3%. Now, obviously, the government shutdown is going to cause a lot of noise into the economic data going over the next couple of months, presuming that the shutdown ends sooner rather than later. But what you'll see on the back half is once the shutdown is over, the economic drag will then become a boost in the preceding months, and everything will smooth out over time. But the bull case for the economy is X the shutdown is 3% growth, and stocks should respond quite favorably to that. The base case is, and this is the environment that we think we're in, is that the economy is moderating. The data is coming in that the economy is slowing. We've come a long way from the Great Recession. The juice, the punch from the tax reform is now behind us. Things are settling in, and we're in a decent environment here, but we don't forecast recession, although recession is always on the table, right? Clearly, that's the bear case. The bear case is that the economy is slowing faster than what we're forecasting, faster than what's coming in the data, and faster than what's being said in corporate earnings, because corporate earnings that have come out so far do not indicate recession. The second one is, it sort of dovetails with the U.S. economy, is where's the Fed in terms of monetary policy and where are market expectations? Now remember, for 9 months of 2018, the story was not if the Fed was going to raise rates, it was how much and how fast. The Fed raised interest rates 4 times in 2018, and the projection up until about August was that the Fed would raise rates another 4 times in 2019. And the Fed really changed course, as did market expectations in the fourth quarter. The Fed went from, how many hikes are we going to do into 2019? Then by October, that was in August. Then by October, the Fed was saying, well, maybe we're closer to neutral than we think. To then the most recent comments coming out of the Fed at the beginning of January is that the Fed is being patient with the data. Now the market reads that as the Fed is going to step to the side. The Fed has already lowered their intended forecast for interest rates to go from 4 hikes in 2019 to only 2. And presumably, if they're going to be patient, those 2 hikes, if they go through with them, will be spread out through the course of the year. What you have here on the chart on the right is where does the market think the Fed is going to be, and where does the Fed want to be? So this blue chart here, this blue line is where the Fed wants to be. So the Fed is trying to get the Fed funds rate today at around 2.4% up to about 3.1% by 2020. So you're talking, another 70 basis points of rate increases over the next year and a half. Well, the market doesn't think the Fed's going to do that. Here's the market expectation, right? The market thinks the Fed is basically at a neutral stance now and is not going to go much higher. And why does this matter? Well, it's this spread that changes expectations. If the Fed is more aggressive than what the market thinks, well, then bonds and other asset classes, yield-oriented classes, are going to sell off because that's the gap. If the market's right, which, by the way, the market has been right on the Fed has been targeting a faster growth rate, a faster rise in interest rates than what they've actually done. Their forecast for inflation has been way off the mark considerably. So, the market thinks we're basically at where we should be. And then that leads to our bull, bear, and base case. The bull case, particularly for stocks, is that the Fed is at a neutral stance. They're not going to raise rates anymore. And with interest rates at 2.25%, 2.5%, companies can still operate and generate a lot of cash flow and borrow at reasonable rates to grow earnings and to improve their business and do all good things for the economy. The base case is the Fed followed through with their announcement, with their hike, but they do one hike in June and the other one in December. And then presumably after that, they would be done. They don't necessarily have to raise rates in March. It doesn't have to be consecutive quarters that they've been doing it. They could allow the data to marinate, particularly coming out of the government shutdown and or the global slowdown led by China. And finally, the bear case is that the Fed is already way behind the curve. If you go back to where the health of the economy is, the bear case was that is the U.S. already in recession? Well, what if the data is slowing down significantly more and the Fed has raised rates too much? Then clearly that's a bad case because it takes some time to unwind that. David, do you have any comments on this point here?
I think you put it well. One thing that I would emphasize to people is that it's not just who's executing monetary policy, it's central banks around the world. And of course, we have seen the Chinese now continue to start to open the spigot. The European Central Bank, the so-called ECB, is slowing its outlook for possible tightening. And just this morning, we heard, it's a rumor right now that the Federal Reserve is not going to be selling off any of the bonds it accumulated. Remember, it bought bonds in terms of for quantitative easing as another way to inject cash into the system and boost the economy. Then by selling it off, that has the effect of going into reverse. Now that they're going to stay constant, we think that's another reason to be very positive for this year. They say don't fight the Fed. Last year we had to fight the Fed. It didn't work out that well. This year it looks like the Fed may be on the side of the market by sitting on its hands or potentially by 2020 easing interest rates. Thank you.
Great. We'll go to the next slide now. Before I move on into this issue on trade wars, again, don't forget, if you have any questions, please go to the chat room. I see some questions coming in now, so don't be shy. Again, all the questions are private, so no one else can see them except David and I. The third issue that's a cross current in the investors' minds, obviously, is trade wars. So, we're now 9 months, 10 months into when the Trump administration started pounding the table against other countries, in particular against China. We know what happened over the summer in terms of the U.S. ramping up tariffs on China to $250 billion worth of goods. The Chinese are currently taxing on $110 billion of U.S. goods. And this impact has been felt specifically on the Chinese economy. It's not a surprise that the Chinese economy is slowing. In October, the Chinese did some quantitative easing. They lowered their reserve requirement to stimulate their economy. The Chinese stock market was down 24% in 2018. So they're feeling it right now. Right now, we're in this truce period. We're halfway through it. The truce was supposed to be 90 days from the start of December until the end of February. We're rolling into Chinese New Year in about 2 weeks' time. So, where does this go? Because clearly any tweets, comments, rumors from either side, the U.S. or the Chinese, regarding this issue has moved the market dramatically. It happens on a daily basis. So what do we have? The bull case, right? The ultimate outcome is that both sides resolve their issues and walk away, and that this trade war is over and there are no tariffs. And the Chinese concede to the U.S. and the U.S. concede to the Chinese for their issues, and we all move on. We don't think that's very likely, but that clearly would be the bull's case. The base case that we think is both sides concede a bit. Maybe both sides cut their tariffs, the dollar amount, in half. Maybe the U.S. goes to 125 billion, the Chinese go to 55 billion. They concede on some of the issues that each side has, and they continue to negotiate over time. We do think that's probably likely, given the impact that this has been felt clearly on the Chinese side and the Chinese economy. But the U.S. economy, there are certain sectors and industries that are feeling the impact. And as earnings season comes out and data comes out, and companies are able to parcel out the impact of the trade wars, i.e., Apple with iPhone sales, maybe the Trump administration relinquishes a bit. Finally, the bear case is the Chinese are unwilling to negotiate. The Trump administration becomes more aggressive and does decide to tax all $500 billion of Chinese goods at a higher rate, which would then turn the entire global economy on its head, and it's probably the stock market with it. David, did you want to add to this?
I think you put it well. One thing that I would emphasize is that neither side in this protracted dispute really is interested in destroying their own economy. And I think both sides will ultimately realize that they benefit by coming to some sort of resolution. So that's fairly positive. We believe that after the fourth quarter, where we start to see the market slide dramatically, that there's been a new constructive attitude on the part of the administration in terms of getting something resolved with China. We think that's bullish, and that's one of the reasons I think this market has gotten off on the right foot. The one cautionary note, of course, is that we have been seeing for actually several years now some signs of real slowdown in the Chinese economy. It's not at all clear that if the trade war goes away completely, that the Chinese economy stabilizes immediately. So there's a lot of moving parts. It's hard to tease out in terms of the Chinese progress, what is due to tariff imposition and what is due to some fundamental overheating that's now starting to cool down. Thank you.
Now we move to corporate earnings, right? This is the issue that was called into question in the fourth quarter, because as companies were reporting earnings, they were low, although most companies, more than 70% of companies in the S&P 500 were outperforming their expectations. Their guidance was significantly lower, and three of the issues that we mentioned prior were part of the reason. So earnings season has begun. The financials kicked this off, and by and large, the banks did pretty well. Expectations for companies in the S&P 500 are to grow year over year 6.1%. Guidance for some companies are better than others. We're seeing from some of the tech companies, which is 25% of the S&P 500 and was a major drag on the index, have a good outlook or better than expected or not as bad as feared. That's basically where we are, is that the guidance may not be great, but it's not as bad as feared per the sell-off of the market in the fourth quarter. So there are headwinds. The dollar has been a safe haven as the global economy has slowed down. Companies in the S&P 500 get about 30% of their earnings outside of the U.S. So clearly a strong dollar is going to hurt translation of cash flow from a currency standpoint. Trade wars, now that we've had 6 to 9 months of these to marinate, we're keeping a close eye on how that is impacting companies' expenses, and are they able to pass through pricing to their end consumer to offset the tax? And same thing with wages. We have a chart here. One of the the concerns with the market is that, are we at peak margins for this cycle? I mean, look where we've come, from a margin standpoint. I mean, it's just been just a heroic story from corporate earnings to go up and to the right. And, you can see with each dip, the U.S. economy is very different what it was in the past. We are much more of a service-oriented economy and less cyclical. So, there's always the case of mean reversion on earnings. Maybe we're at a peak now, but we probably have a step function down and then higher again. So the question then becomes bull, bear, and base case on where we are from an earnings standpoint. The bull case is that more than 75% of the companies in the S&P 500 beat analyst expectations. That would be outstanding. And the key, where are we on future guidance? That's the issue. Because if companies come out and say, well, our earnings are great and we see greener pastures ahead because the price of oil has been cut in half, or we're not seeing tariffs impacting us as much as we thought, or the lower corporate tax rate has really been a good benefit, or our end customer is not seeing any slowdown in demand, therefore our sales are growing, that's a good thing because the bar has been reset from a market expectation standpoint. What we think is more likely is that more than 65% of the companies in the S&P 500 beat analyst expectations. This has basically been the premise since the first quarter of 2010. Companies have done a very good job in terms of managing earnings, whether cutting costs, growing their top line, and or buying back stock. And at the end of the day, a stock's price is the discount of future cash flows, and what is the market willing to pay for it? Well, prior to Christmas Eve, the market was very fearful of stocks and it was very cautious of what future cash flows were and didn't want to pay for anything. And now you've had over the past month this really strong rally in stocks, and the perception has changed once again that things aren't as bad as we may have priced in. And obviously the bear case, and you can see it consistent with all the other slides, is that the U.S. really is in recession already, and future guidance is portending that the future is going to be worse than it is today. And the outlook doesn't look very rosy, and therefore we're headed into a bad territory, bad situation, and therefore profit margins will go down lower, and the multiple that people will pay for earnings will be a lot less, and that's a bad thing for stocks. David, did you want to add anything to this part?
The one thing that I would add is that the fundamental reason for bullishness for this year is that almost all expectations are for an increase in earnings overall versus last year. The rate of growth won't be nearly as extreme. You're making comparisons versus quarters now that will have already had the massive tax cuts that we saw at the end of 2017. So higher earnings, interest rates at bay, could lay the foundation for the market to go up and touch the all-time highs that we saw last August. That's the bullish case. One of the things that's very frustrating is when a company announced, but their guidance is cautious. But we take some of that with a grain of salt, and sometimes a big sell-off there, because the extent the caution is due to what's going on with tariff negotiations, what's going on with interest rate policy, the health of the global economy. Typically, those companies have no edge on forecasting those any more than anyone else does. And so why shouldn't they therefore be conservative there? And that ultimately, if the sell-off following a weak forecast based on those issues is enough, then that may be an opportunity to step in and take advantage. Thank you.
So the last slide here is dysfunction in DC. And the next 2 years are going to be noisy. I mean, both parties are setting themselves up for the re-election. Obviously, the wall is a big, or the barrier is a big campaign issue that Trump has run on. The Democrats remember all too well how the Republicans stonewalled President Obama really in 2011 and into his re-election and when he was re-elected. So they're gonna come in hard, and they're not gonna play nice in the sandbox for as long as they possibly can. So don't expect that, or expect the noise to continue. Hopefully there's some resolution on the shutdown, but the bull case is that both sides can find common ground. The government shutdown concludes soon. we would love for that to be the case, but just don't see that happening that right now, at least under the current format. Gridlock, that's sort of what we're in, right, with the exception of the Senate. But the third year, the presidential term has always worked out in favor of investors. President Trump, his favorite public opinion poll is the S&P 500 and where the stock market is going. So he's going to do everything he can to head into his reelection, his campaign season with a strong economy at his back. So a lot of the issues that we talked about earlier, again, it's in his best interest to be reelected to make those things go in the right direction. And most Americans now, particularly through 401ks and retirement, have exposure to the stock market. So he needs that to work for him. So we do think that the shutdown will happen soon. Will come to an end soon, or at least hope it does. The bear case is that neither side can find common ground. And the Fitch, one of the credit agencies, has already come out and said, if there is no resolution to the shutdown by March 1st, they're threatening to lower the credit rating on the United States debt. So, go back to August of 2011 when the U.S. was bumping up on the debt ceiling. You had a lot of this fighting, and it took to the 11th hour basically to come to some conclusion, to kick the can down the road and either push out the debt ceiling or come to some resolution. And the bear case would be that come February, we're dragged down that road again. Investors get spooked and they run for the hills and sell their stocks. So, that case, we hope it doesn't happen, but clearly there's a likelihood of it. David, did you want to offer some comments on what's going on in Washington?
Well, certainly neither side has any interest in really doing any major harm to the economy or to the financial markets. Certainly at any time there could be a resolution. So we certainly urge clients not to change their long-term investment plans over this issue. As frustrating as it is and embarrassing, it should not give rise to fundamental change in your long-term investment outlook.
Great. So that concludes the presentation portion. Like I said, we could have spent an hour on each one of those topics, but we wanted to give you an idea that there's a lot of cross currents out there. It's not an easy environment to invest in. We continue to preach diversification. We wanted to lay out the different scenarios that can happen within each one of these of what we think are the biggest issues, spooking investors or on investors' minds today. There are some questions coming in on the chat room, so please feel free to put your question down, and we'll do the best we can to answer it. If you're new to the format or if you have questions, you want to reach out to PointView, here is our contact information. We do these webinar series once a month. We have been doing for the past 6 or 7 months, and we continue to do so. We get great feedback on them. So here's our contact info. Everyone will get a link of the replay of this event. So don't worry about that. Or even future webinars, you could register. We'll send you the replay. But the important thing is to register. David, a couple of questions are coming in, and I'm going to package. There are 4 questions that have come in. I'm going to package 3 of them into one because it's about asset allocation. So the questions are, how do you think stocks will finish by year end? Are bonds a good investment today? And does owning gold make sense today? So I think all those can kind of be wrapped up together. At least that's how I think about it. Do you want to give it a shot?
Yeah, absolutely. Well, I think anyone who tries to make a short-term prediction on the markets is foolish. There are just too many extraneous factors, geopolitical developments, policy-making error, just basically panic or euphoria in the markets to ever try and make even a 1-year prediction. Having said that, I truly am bullish for this year because I believe, as I mentioned before, earnings are going to be greater. The Federal Reserve is going to be tamer in terms of the interest rates, and that could mean the expansion of price to earnings multiple on a higher level of earnings, and there's no reason why we couldn't hit all-time highs. But, our job at PointView is not to make a big bet, not to make a prediction which we know we can't guarantee, is rather to prepare for any type of environment. And that's why we urge all of our clients to have a carefully allocation between stocks, bonds, and cash. We know that all sorts of things could make people leave the stock market. And where are they going to go? Historically, they've gone to high quality fixed income. So we always feel that people should have a nice helping of fixed income to reduce volatility in their portfolio and potentially give them some dry powder to take advantage of any bargains that may develop during the year. Now, tying the gold question is, quite frankly, the more diversification you have, the less risk you're going to have because you're going to have more things beating to different drummers. So having a small allocation to gold as a hedge on inflation, geopolitical uprising, really bad economy is, we think, a smart thing. And given that gold in 2014 was over $1,900 an ounce and now it's close to $1,300, you're certainly getting a better bargain than you did before that. But on balance, we're traditional stock and bond investors and not precious metals investors.
So just to sum up the comments on the bonds, you wouldn't advocate for 100% bond portfolio because on an absolute basis, bonds have rallied, particularly over the last 3 months. So on an after-tax, after-inflation return, bonds aren't great. But from a diversification standpoint, you really would advocate to have a bonds as a portion of your portfolio because as we saw in the fourth quarter, they provided a lot of stability when the market sold off hard. Is that fair to say?
Absolutely, John. I mean, having bonds is a little bit like making the payment on your car insurance or home insurance policy. It's kind of a dead loss compared to other uses of your money. But if something goes wrong with your vehicle or your home, you're going to be very happy that you made those premium payments. So we look at bonds in that manner. But there's no question with the 10-year Treasury at 2.7%, when you're done paying taxes, when you're done with the effective inflation, it won't get anywhere to where they want to go longer term. Mm-hmm. So you don't want to overdo that insurance policy, as it were.
Yeah, I'll make a comment on the gold question. Gold for 9 months of last year, along with bonds and yield-oriented securities, really got thrashed because the market was expecting rising interest rate environment. And then when this flight to safety happened in the fourth quarter, gold caught a bid. The interesting thing about gold, and going back to the dysfunction in DC, let's play out the bear case that there is no government. The government shutdown is not resolved a month from now, and the rating agencies start pounding the drum that they may cut the credit rating of the U.S. Debt rating from its AAA status. Well, then where should investors go? I mean, the irony, what are you going to do, buy treasuries? Well, isn't that the credit rating that was just cut? So therefore, that's what makes gold a bit, or at least the gold miners, in our opinion, a bit more of an attractive investment opportunity. And you don't want to wait until that happens. In fact, we typically have, an allocation to gold and or the gold miners in a diversified client portfolio because there are always events like what happens if tensions between North Korea and the U.S. pick up again, or if there are issues in the Middle East, or there's that unforeseen black swan event. Where having some allocation to gold and or the gold miners in a client portfolio makes a lot of sense because, we like to prepare rather than react. And we're humbled to know that we don't know what the future outcome holds. So we want to protect and have some allocation to those unforeseen events that we just don't have the crystal ball to foresee. That would be my thoughts on the gold question. One last question here is, many people are saying that there'll be a recession in 2020. What are your thoughts on that? You want to take a stab at that one, David?
Sure, absolutely, John. Thank you. I mean, when it comes to forecasting the economy, I always take a page out of Warren Buffett's book. He said that the good Lord put economists on look respectable. And of course, Peter Lynch, who's that legendary manager of the Magellan Fund, said, if I spend 15 minutes thinking about the economy in terms of my investments, I probably wasted 10. The economy is very difficult to project. Remember, the Federal Reserve did not project what was going to happen with the economy just like 2 weeks before the Lehman bankruptcy. So what we prefer to do is have that very diversified portfolio where we have an allocation to low risk income producing investments, primarily high quality bonds, to offset the effect of a recession. To the extent that people are selling their portfolios and liquidating because they think the recession is around the corner, that can be an opportunity. And whenever someone starts saying absolutely no recession in our future, that's probably when you want to be a little cautious. So, as John says, prepare, don't react as the forecasts for the economy come in.
Great. Before we close up here, just going back to our poll, do you think the U.S. political situation will send the U.S. economy into recession? 33% of you said yes, 67% said no. So I guess that is reassuring. Well, listen, thank you, everybody. There are no further questions that I'm seeing coming up. Thank you, everyone, for joining us. Be on the lookout for our next webinar at the end of February, topic to be coming. And again, we appreciate your time and attendance. And if you can't attend the event live, register anyway. If you have a family member or a friend or colleague that you think could be interested in the topic that we're presenting, have them register and we could always send the link. And obviously, if you have any questions that you want to reach out to us on, feel free to do so. Here's our contact information. Like David said, we're based in Summit, New Jersey. So we'd love to hear from you and meet from you. All right, so take care, everyone. Have a great weekend.